Good morning, everyone. Welcome to the Morning Kappa at 8 on a Wednesday. We are here to present the Midweek Futures Traders Technical Brief, and we are on week 2, December 2025. We've got a very interesting table here, and from the previous week, we have seen that there are a few of the markets, especially the indices, holding up, especially the US indices, including the Japanese market. For Hang Seng Index, we saw that the positive setups have now come into negative, very volatile situation. But on the other hand, the China A50 has remained to be positive in its posture. KL Index, right? We saw a neutral position coming back into negative. Again, it could be a position of range bound situation due to the lack of direction. Palm oil wise, from the previous week we had neutral, but the performance this week has been bearish so far. For metals, very interesting. Silver has hit a new high. Copper, although positive, has taken a big dip. Gold is still neutral, looking for the next move, likely to be on the upside. So do look out. But today we have got two products we'll be focusing. One will be from the agriculture side, corn, and the other one will be copper. Crude oil, still neutral, directionless. So that would be left to another day for us to talk about. We go into the popular product, which is CPO. Currently, the news that has been determining the direction of palm oil has been basically the weaker Malaysia export performance. The early December shipments have fallen more than 20% as compared to the prior month, according to ITS. And this is a concern as the demand from key importing nations has been lacking. Also, China's soybean procurement is one which has also been pressuring prices generally and globally because China has not achieved its December commitments under the US agreement. So for palm oil, likely the 4,000 level will be retested, and so that would be the support for the time being. Moving into the US indices, a lot of the markets have been holding firm in the expectation that the 25 basis point cut will happen this week, and turning investors' attention on Jerome Powell's remarks and the pace at which any further easing might follow. The direction appears that the Federal Reserve may hold off further easing to be sure inflation isn't hitting up. So you can see that very mundane kind of movement in the positions as reflected in the commitment of traders here. And the only movement that we have seen that is relatively significant will be the S&P 500, which has dropped a total of 8,000 number of short positions. So otherwise, markets are hovering at the high end and waiting for some kind of direction to be determined, in the weeks ahead. Coming back to metals, as I mentioned, this would be something that has developed into some kind of situation whereby we are unsure. But looking at copper, there has been a sell down despite of a tight supply situation for copper generally. But for gold and silver, positions have not moved a lot, although silver has gone to new high, and gold is justifiable for non-movement in positions because of its neutral position. But today we'll focus on the copper, And so for copper, basically, we have seen the uptrend recently is mainly driven by shortages, which due to unplanned disruptions at major mines this year, and these have actually strained market. Meanwhile, further stockpiling in the US due to concerns that the Trump administration could levy refined metal imports next year is also raising the risk of shortages in other regions. So to me, copper is looking pretty interesting as we see the uptrend is still pretty much intact, and this is almost a 3-week trend. Some kind of correction, of course, is obvious, but for us looking at the setups, we have got a profile that is positive, also a short-term setup that is positive, and the current price of copper is at 5.323. Reference price is at 5.36. So we are looking at potential upside movement before there is a position to be executed here. And at 5.36, the potential profit price will be at 5.55. That would give us a value of a USD 475, and a potential loss price in case it drops below the 5.18 will be a US dollar value of negative 450 US dollar. Moving ahead to agriculture, and from this commitment of traders, for reasons that we already have seen, soybean is the highlight. It has actually increased in over 70,000 number of short positions. And for soybean meal too, it's been heavily on the short side, whereby about 30,000+ odds have been increased over the week. Soybean oil, which is very related to our palm oil, is down by about 7,000 lots in short position, indicating there has been some short covering. And the other one is corn, which we're going to focus this morning. If you look at corn, the positions have built up to be very short, increasing by over 70,000. Otherwise, the news that's been driving corn prices, all right, basically the fresh demand and also tightening near-term supply is the factors which have been holding up corn. On the demand side, US exporters have already reported large new sales to Colombia and Mexico, and overall commitments remain well above last season. Also, US ethanol production have climbed to record weekly rates at the end of November, and this has increased feedstock use, and also buyers in Brazil have also stepped up purchases to rebuild inventories ahead of year end. So that's why, to me, the corn is looking interesting. So there is a market guide on corn. Current setup is positive, and current price at 448, which is actually the price this morning. Yesterday, the reference price was hit at 447.5, and at that price, the potential profit we're looking at will be at 454.5, giving us a US dollar value at 350, and also a potential loss price at 440.5, a loss value of 350, and this we see that is a profit to loss ratio of 1:1. So seldom we see there are not many of these ratios at 1:1 recently, but this is corn, and this is one which currently we see looks pretty interesting. So that's all I have for all of us this morning. Thank you, and I'll pass on to the next speaker. Over to you, Joseph.
Right, morning, everyone. Welcome back to our morning cuppa at 8. So looking at the Hang Seng Index, right, what we do see yesterday is that the index have experienced a very sharp corrections, both on the Monday and Tuesday sessions. Um, Sentiment has become more cautious on the tech related counters, but we do see that the funds are moving to some the mid and smaller cap at the Hong Kong market. So at this juncture, we still keep a bullish trading bias on the Hang Seng Index as long as the index stay above this 25,000 point level. As of yesterday, right, what I do see is that the SMIC 981, which is the leader in the front end semiconductor fab, is testing the 68 Hong Kong dollar support level. So if it pull down lower, the next support level will be at 60 Hong Kong dollar, right? And based on yesterday momentum screening, right? Fit Hunting have come into the screen. Stock code 6888. The stock managed to break past 5 Hong Kong dollar 50 cents, right, on the back of high volume. So the breakout it should be heading towards 630 and followed by 7 Hong Kong dollar. Downside support is 5 Hong Kong dollar. Then on 1114 Reliance China Automotive. Also a break past the 4 Hong Kong dollar 20 cents, heading towards 4 dollar 60 cents and followed by 5 Hong Kong dollar. Downside support is 3 Hong Kong dollar 80 cents. So Fit Hunting is a breakout stock, and Reliance China Automotive have a second breakout since the first breakout that we saw in the September month. So right now, December month, they had actually a second breakout on the higher high movement. Right, and I think one thing that we are waiting for tonight, basically the firstly is the Fed interest rate decisions. Market is expecting one rate cut. We can see that 88% believe that there will be one rate cut from 4% drop to 3.75. Another 11% thinks that the rates will hold steady, right? But I think that more or less what's Fed decision today sealed, or if they cut, right? But more important is that the what happened on the 2026, right? As we can see, about 1 month ago, uh, about 1.5 months ago, 27% believe that the rate will have a very sharp corrections from 4% to 2.25. As of just now, when I look at the chart, right, it only dropped to a 3.25, which means right now the market thinks that there will be a rate cut into next year as well, but it's not going to be as steep at what they would think previously. And this change of the rate expectations do have impact on the equities market, especially what kind of discount rate that we are going to use, or equity premium, risk premium that we are going to put when we value the equities market. Hence, you can see that this is the last Fed meeting of the year, and before we go on the next year, definitely this December meeting will have the impact on the first quarter next year before the Fed is going to have their next meeting, right? Hence, I think today the outlook of the Fed is going to impact the sentiment on the market, especially the dot plot diagram that they are going to chart after the rate meeting. Secondly, the S&P 500 moving sideways, hovering at just 6,008 level, right? So I think overall our trend remains positive so far, and tonight, there will be a results earnings from Oracle. Now, Oracle is one of the interesting counter that we have discussed previously. So I think that will actually move sentiments on the AI related counters in the market. But overall, I think So there will be two events that will be affect the sentiment. Firstly, the Fed, and secondly, the Oracle's earnings. Now, secondly, what we just want to recap on some of the counters that we have mentioned. Now, you look at the under the auto sector. This is the watch list that I've mentioned to you quite some time ago, right? CVNA is one of our uh, favorite counters in the auto sectors. And look at the chart this morning, right? Kavana have managed to break past the R2 level, right? It shows that our technical picks was spot on. And secondly, right, one of the counter that involved in the utilities or the telecommunications in the US, which is the coherent, right? COHR also break past the R1 and R2 levels that we have projected, right? You can see that under telecommunications, there will be one counter that's in our watch list, which is COHR. Hence, while you are coming into a morning kappa, right, do actually pay attention to some of the watch lists that we have given, right, actually composed. Some of them actually fits the fundamental criteria, but because of time, right, I seldom talk to you on the fundamental perspective, but we just look from the technical perspective. Okay, right. And as for the FKLI, we continue to keep on the bullish bias. Once since it's bouncing off the 1008 support level. Um, after the we conclude the MSCI rebalancing last week, right? We have moved up the stop loss point from 1570 to 1600, and based on the latest price actions, we do see that past two sessions, the candlestick have a long lower shadow. Now these two shadows shows that the market respect on the 1006 level. So let's see how the index will pans out just before the Fed meeting tonight. So I think likelihood the index is going to move sideways just above 1006 pending the announcement from the Fed. Now, secondly, looking at the FCPO, right? Yesterday also charted a long lower shadow as well. It have actually reaffirmed what we have seen recently, that 4080 is a very critical, one of the more important level for the FCPO. Just before the MPOB going to discuss release their November data later at around I think 1 p.m. right. Um, so apart from the MPOB data, right, I think today is the 10th day of the December, right? Market will also look forward what's the export number for the first 10 days in the market, as what Vincent have mentioned just now. Rather than the inventory numbers, what the market is actually want to actually look at is whether the importers start to import, or whether we manage to export more to the market as we are approaching the Raya in next year, March, right? So 4080 is the first support level, and then followed by the second support level at the 4000. And on the upside, 4250 is a very crucial resistance, and we set our stop loss at 4250. As long as the FCPO stay below the 4250, we'll keep the bearish trading bias unchanged. Now, meanwhile, the trading stocks this morning, firstly, we have the IAB, right, which have climbed above 90 cents resistance. The R1 set at 97 cents, and followed by R2 1 ringgit and 4 cents. Downside support is at 83 cents. And secondly, we have cheating, which are heading eyeing to break out from the 82 cent and half. So if a breakout happens, cheating will be climbing towards 85 cents and followed by 87 cent and half. Downside support is marked at 80 cents. So we have one breakout stock, IAB, and followed by a pending breakout, Cheating Holdings. Now, before I pass on to the next presenter, I just want to update you that this morning we're going to have LAC Med, which they are going to list in the main market afterwards. So LAC Med have issued their IPO at 75 cents, which is going to give the company at around 300 million market cap. So basically, the company is looking for this IPO as an opportunity to capture the next wave of the healthcare spending in Malaysia. And they also want to venture into a regional, especially they start off their first spot in Indonesia. So LabMed basically is in the business of distributing medical devices such as the MRI, ultrasonic equipment, the consumables, and some of the software solutions that are going to integrate the medical equipment in the hospital. So basically, they are the distributor for a few brands such as the Samsung, Philips, Striker, LG, Abbott, and Bayer, right? So these are the product they are distributing, and apart from pure distributor, they're also in the they're also tapping on the AI technologies to actually integrate some of their equipment in the hospital so that the usage of the equipment are more efficient. And based on their latest announcements, their IPO have received 12.6 times applications. So they have oversubscribed by 12.6 times, and the IPO price is 75 cents. Okay, so I'll stop here and pass on the stage to Eddy. Thank you.
Hi, good morning, everyone. Thanks, Joseph. A short one from me. This is a sector update with regards to the third quarter results for the rubber products, for the rubber gloves companies under coverage. So in essence, the glove sector's September reporting quarter disappointed, even as industry dynamics turned more nuanced. Price competition intensified among Malaysian glove producers, leading to uneven quarter-on-quarter volume recoveries despite expectations of a stronger rebound following the absence of the gas supply disruptions. In terms of industry blended ASP, this has slipped to $21.30. This is based off Hata's blended ASP number. And as cost pass-throughs remain difficult in the face of softening raw material prices. So a bit on the results of the 6 glove companies, 6 rubber products manufacturers under coverage. Only Top Glove beat expectations. Hata Lega reported inline results, and the remainder missed projections. Some of the key observations here: number one, uneven volume recovery and unfavorable shift in sales mix towards non-US market. Number two is the widening ASP divergence across manufacturers given differing operating strategies. And lastly, we are seeing sequential improvements in the operating profit per carton, which is per 1,000 pieces, supported by operational efficiencies as well as the lower input cost, which is the lower raw material cost. Our earnings estimate revisions in this quarter mainly reflects the lower sales volume assumption as well as the USD MYR expectations. And in terms of some forward-looking guidance, management commentaries across briefings indicated continued ASP pressure, potentially exaggerated by incremental supply from China manufacturers with offshore facilities, such as the Indonesian capacity that is been talked about. Indonesian-based capacity has begun commissioning in stages with ASPs estimated to be at USD $1 to $2 below prevailing US ASPs of USD $17 to $18 per carton for generic products. This is ASP for generic products. Besides that, there is also some OPEX headwinds, which is set to materialize. For example, the mandatory EPF contribution for foreign workers, which is effective October 2025. That is expected to raise glove makers' cost of production by 0.1% in terms of ASP. And there's also talks about a multi-tier levy mechanism on foreign workers, which is set to roll out in 2026, but there hasn't been any confirmation yet. But that could raise the production cost by about 0.4, 0.5% of its current cost base. The current ASP per carton, right? The silver lining here lies in whether ongoing cost rationalization initiatives can translate into meaningful margin expansion. In terms of strategy here, the sector is trading at 0.9 times forward price to book, which is at around 1.5 standard deviation from its 5-year mean. But we think that this reflects the persistent structural headwind. We are maintaining our underweight stance on the sector, but we adopt a more tactical stock selections in view of improving short-term risk-reward profile. During the quarter, we did switch our call for Supermax to trading buy from sell. The key swing factor here for us is the inflection in operating cash flow, which has turned positive from negative. But it's still small. But that challenges the bear case narrative of persistent cash burn for Supermax. And with a net cash position of 691 million, which is about 57% of market cap, and the valuations is at distress level, we do think that there is some near-term trading upside. Key risk to our sector rating, a stronger USD MYR rate, also increase in glove ASPs, capacity expansion, as well as lower than expected raw material prices, should bring the glove sector to a more favorable outlook. But we are maintaining our underweight call here, and that's all from me. I'll see you guys tomorrow at morning kappa at 8 a.m. Thank you.